Let's take a quick look at some ratios, a little ratio analysis. I know I've talked more about the basic financial statements, the income statement, the balance sheet, and the cash flow statement, which need your most attention probably. But taking a look at some ratios can help us out a little bit with some stuff. And this is one of those cases too. I think if you flop over to the FINRA, might give you a little better information. Kind of that's probably an opinion anyhow. So use both. When you're taking a look at these, use both. I'll start though with some stuff on the seeking alpha, and it doesn't say ratio analysis. Some of these used to actually say that, but it gives you some things to look at here, right? So let's take a look, for example, at growth, and that's where we're going to see some kind of ratios, right? We got revenue growth. Well, its 5-year average has been 5.99%, almost 6% per year. We don't know what the sector is, and it doesn't matter necessarily. That's year over year. Revenue growth, I think this is forward looking, right? Yep. That's an estimate, okay? Basically close to the average, right? Some of these maybe get a little bit too complex for where we're at right now. I don't know that we need to worry about EBITDA, earnings before interest, taxes, depreciation, and amortization, right? And we haven't talked a lot about that. So, ROE growth, though, it's actually declined, over the last 5 years on average. Yeah, that might be a little bit concerning. Their ROE is still really good. I think we'll find some of those as we get into there, but it's gone down a little bit, okay? There could be, remember that ROE is return on equity, right? So there's always two factors. There's the return, which is our net income, right? And then the other is equity. Well, what if their equity has increased dramatically? Their ROE would go down. Not necessarily a bad thing. They've had increased equity. Maybe they've got increased retained earnings, right? So you got to be kind of cautious when you look at something like, the ROE growth rate being negative. Maybe not that bad. Yeah, working capital, not too bad. So that's a working capital, right? Current assets minus current liabilities. Generally a positive in terms of liquidity and some things like that. So, a quick glance at these things, right? Profitability, gross profit margin, something I've often, preached on a little bit. I think that's a big item. So, the recent one here is for the trailing 12 months is 49.32%. But look at their 5-year average is 40 or 53, almost 54%. So difference again of about that 5%, right? Okay, that's gone down. And we kind of addressed that when we looked at the income statement, right? And we looked it up and what's causing some of those things, right? Okay. What are some other ones, Yeah, net income margin. This is when you take out the operating expenses as well. Return on common equity, right? So return on equity, we're talking about that. It's still 30.07. That's pretty good return. Okay, its 5-year average was 38.7. That's why we saw that decrease. Okay, in that prior one, it's gone down obviously over the last 5 years, but still not too bad. And again, part of the reason it went down might be because equity has gone up. That's not necessarily a bad thing. You might have to go look at that, right? If you went back to the balance sheet, you'd see what's happened to its equity over the last 5 years and see if that's the cause or if the cause is because of reduced income. I think their income's been going up, if I remember right. So if their income's gone up every year, but their return on equity's gone down a little bit, it probably means that their equity's gone up. Not necessarily a bad thing, right? Some of these return on total assets, that's a huge number for banks, which none of you are doing banks, okay? Maybe not as important for this type of an industry. And again, the reason for that could be the types of assets that they have. Might be important if you looked at it over time for a company like that. The asset turnover ratio, again, might be a huge item for some businesses. I don't think I'd focus too much on that for a business like WD-40. Yeah, momentum just kind of gives you some things about price performance. We're not worried about the price, right? So let's forget about that. I don't know if I hit valuation. price to earnings ratio might ultimately be something you would look at. Okay, if the price to earnings ratio is relatively high, and it is for WD-40, that's a fairly high price to earnings ratio. Okay, the full S&P right now is probably running about 17 or 18 price to earnings. So WD-40 is 43. So the expectation would be that WD-40 would be a company that grows faster maybe than the S&P. Yeah. I'm kind of getting into some things that maybe they're a little bit of an aside, kind of more of it is an investing thing, so ultimately could be important. But maybe a little too far along for what we're looking at for your guys' paper. So let's get off of that and let's go over here to the FINRA. Okay, and if you click on the FINRA, the link that I give you, it should bring you right to this page. Right? And if we plug in the ticker symbol, there we go. Key ratios. That's kind of cool. We got a revenue growth rate, some different things that are kind of similar. Okay. If I scroll down, it's just going to kind of go through these, and the one I probably want to get to is maybe the valuation, the financials. I can actually click on them and take me down there, right? I think this actually will give me some basic financial statements. Not as good as the ones I get from Seeking Alpha. So I'll come down here to the valuation. Again, we're into that price to earnings, price to book. Yeah, not necessarily a big deal. I don't know that I'd worry about that. Operating performance. So this one here, okay, return on assets. Remember I said that can be important, more important maybe for some businesses than others, but at least it gives us a look, right? Okay. So that return on assets has been, over time. Actually, if you go back, to 2013, so 10 years, it's improved quite a bit over that 10 years. Okay, that's a pretty good thing. They're obviously able to generate more income on fewer assets. That's a good thing. And return on equity, that's kind of all over the place. Okay, and again, maybe largely because you can have big time differences in the equity. Okay, return on invested capital. Yeah, some decent growth there, right? The index would tell you what other companies in the sector are, and so in each case, WD-40's returns or 5-year average anyhow is far better than the index. That might tell you why their price to earnings ratio is a little bit higher. Okay, dividends. Remember we talked about dividends. It actually did decrease here in 2015. Our other one, we were looking at that 5-year one, and it's gone up. And since 2015, it has gone up each and every year. Okay, that's pretty impressive. That's kind of a nice thing, right? I don't know if I'd worry about the yield. The payout ratio tells you what part of their income they're paying out. Some pretty big payouts here. So their dividends been going up, but they've had to pay out more of their income in dividends. That might be some concern. Yeah, the dividend keeps going up, but if this gets up to 100%, it's not sustainable. Okay. That's pretty much it there for the FINRA. I was kind of looking and see dividends. Nope, we don't need to look over anything else there. So bounce back and forth a little bit. Take a look from at your company for using both of these. It's pretty simple. Use the links that I give you. Click on it. Plug in your ticker symbol, and you might spend a little bit of time. That might even be a separate paragraph underneath your financial analysis that talks a little bit about these ratios and the good or bad about them in regards to your company. And as always, if you have any questions, feel free to send them my way. Thanks. Have a great day.